Hi, everyone, and welcome to the show. Today we have a very special guest, and that's Paul Andreola. Paul, you've got quite the resume currently, so I might botch this. But you're currently the CEO of Name Silo Tech, as well as Small Cap Discoveries. But of course, you've also got more on your plate. You're the board member of Atlas Engineered Products, Total Telecom, and Departure Bay Capital. Let's park on and talk more about Departure Bay Capital, the Capital Pool Corp. You recently deployed funds into I believe a robotics wheelchair company. Tell us more about that.
Yeah, thanks, Robin. Nice to get a chance to talk to you like this. I wear a lot of hats, and one of the recent hats I took on was as the director of Departure Bay Capital, and it's a CPC, as you mentioned. We have found a company based out your way in Ontario that has been working on mobility devices, so predominantly wheelchair assisting devices. And what's really amazing is they've developed a robotic wheelchair encompassing artificial intelligence and a whole bunch of robotic components, really revolutionizing what the wheelchair industry is going to look like. And these are really high-end wheelchairs for those with severe mobility issues. So what we've done is we've actually been following the company. It's a private company. We've been following it for well over 2 years. Found that the company was starting to hit a pretty major inflection point, and decided to merge with the entity as the CPC, and we're funding the company and taking it public through sort of an RTO, which is sort of typical of these type of transactions. So we're pretty excited. It's a very rapidly growing business. As is, they're already profitable, which is pretty rare for these type of companies when they come public. And really exciting about some of the new developments and sort of new milestones that the company's hitting.
Is it commercialized? Are they selling? Are they revenue generating right now?
Yeah, so they've got a product called the Companion, which is a device that actually attaches to a manual wheelchair and turns it into a power wheelchair, and they've been able to grow that at about 60 or 70% a year over the last 3-4 years, and it's gotten up to about a $2 million run rate. But they've just gotten clearance and are applying for an FDA clearance as well to commercialize this robotic wheelchair. So they've made their first first sales. They've actually got a order for 100 units from one of the largest wheelchair dealers in Canada, and that's well worth over $2 million. So they've got sort of that proof of commercialization now. Now it's a function of how fast can they grow.
That's exciting. Who's the founder for people who want to look more into the company?
Eugene and Dima, and the last names escape me, unfortunately. Maybe it's my old age starting to kick in. But what's really fascinating here, the company's called Chilker, by the way. Anybody can look up the company. They've got their website and everything. But what was fascinating is these are two individuals who were not from the wheelchair industry. And they both came from different parts. One, Eugene was a general manager at OpenText, and actually used to run Hummingbird, which was acquired by OpenText years ago. And Hummingbird was a great sort of microcap success story here in Canada. But he has artificial intelligence and software expertise, whereas Dima, his partner, had automotive and automotive engineering expertise. And they saw this issue because a family member became immobilized and needed to, and it really sort of thought through how antiquated the existing products were, and sort of took their expertise and developed this new version of a wheelchair that really has, I hate to say bells and whistles, but the functionality of this wheelchair is like nothing that we've seen. And it encompasses, like I said, artificial intelligence and the latest robotics to really, allow, those with these mobility issues functionality that never existed before.
Are we talking about an autonomous, self-driving, smart wheelchair? Is that what we're talking about?
It's almost at that point. So
Wow.
if like a lot of the issues with standard powered wheelchairs are things that we don't really think about until you really need to use it. One is weight, for example. It takes more than two people to. The typical wheelchair right now, the powered wheelchair, is going to weigh over 500 pounds. So that alone is very difficult to put into a car or to move around. It takes significant amount of activity to make it as useful as people think it is. This wheelchair is 180 pounds. It has an EV battery as opposed to the typical lead acid battery. It drops lower, so it gives a person in the wheelchair more access to things on the floor. It self-levels itself, which no other wheelchair has the capability of doing. It can lift somebody up, actually almost wrap themselves around the person so the person can stand. There's an amazing little video on their website showing a person golfing off this wheelchair. So it's again, a functionality that came about because they were thinking outside the box. They weren't thinking as a standard sort of wheelchair manufacturer. They really, really took these other experiences they had and brought them to bear here.
It's great to see that innovation coming out of Canada. That's just
yeah.
really exciting.
I'm so proud of it, actually.
Yeah.
It's something it's more than just the potential financial rewards. This is something that it makes you feel good knowing that you're doing something like this.
Absolutely. So you had an unusual foray in the capital markets, Paul. You started out in the trades as a carpenter.
Doesn't everybody start out as a carpenter and become an investor? I studied construction management in college. Out of college, I worked as a carpenter and framer, and we did everything from big builds to small renovations. I ran my own construction company for a while. But I think I did enough of that to understand that I hate physical work. And it's, working outside in the cold rain, it incentivizes you to look at other opportunities. And I always had a passion for investing, even, before I got into the construction trades. And then just, had sort of had enough and found that I was enjoying my side hobby of investing more than I was my day job. And literally quit my construction job and started managing a little bit of my own money and a little bit of family money, and was able to sort of find a technique that improved my returns, and then sort of the rest was history. Got the investing bug and couldn't shake it.
On day one, though, did you start out in the microcap world, or did you work your way there?
No, I like a lot of investors, I kind of stumbled my way there. So I really didn't know what I was doing when I first started off, as I imagine a lot of people. And I started to read as often as I could and as much as I could. But most of the stuff you're going to read is about sort of large caps and the sort of the Warren Buffett approach after he became Warren Buffett. It didn't really teach you a lot about what to do in the microcap space, but what I was finding was that over time, I started to look for where I could find an edge, where I had a competitive advantage. And what I didn't mention is, after I started investing, I actually became a broker. I got licensed and became a broker and got to understand the industry from the inside. And that was extremely helpful because I could see what was working, what wasn't working, and also understanding how the industry affects different opportunities. The larger the company, the more likely institutional investors and those within the industry can participate there, and the more ignored the small companies are. So when I start to see that advantage that I had in the small, sort of the microcaps, that's where I started to focus. And when I sort of really refined the criteria I used for microcaps, the returns started to be just outstanding. And so I kind of learned through trial and error that microcaps were the place to be. And especially once I refined that process. And I mean, we can talk about the process, but it was so much trial and error for me. To get me.
Do you remember, Paul, the first few microcaps that you bought in the portfolio?
Well, the first few were actually disasters.
Okay.
Like a lot of it was you think you don't know, so you try to listen to everybody else, and usually when you're listening to somebody else, they may have a different motive than you. And I got sort of snowed by the promoters and all the exciting IR releases and things like that. So and being in Vancouver and in Canada, a lot of it was resource related. So you learn pretty quickly, if you're paying attention, that that's not the place where you can really make money. You've got to go and find something different, and quite frankly, you got to find the ideas almost on your own if you're going to find ideas that are going to really give you the kind of returns you're looking for. So the first few were disasters, but then after a while, after I start to see what worked and what didn't work, we were fortunate. We found some companies early enough and turned into significant winner source.
Yeah, this is the perfect bridge into the next thread here, where how I discovered you. It was through the article you released out of your small cap discoveries service, and I believe the article was called "Reverse Engineering the Perfect Stock." And I thought, this is perfect. I don't know who Paul is, but I want to read this. And it was just basically lessons learned, right, from Z all the way to A. Based on the successes that you've had in your own portfolio investing in microcaps. Can you walk us through reverse engineering the perfect stock?
So what we learned over time is that a lot of the big winners have common denominators, right? They're common characteristics. And when you start to look at them and simplify it, you can put together a criteria that it's not a guaranteed way of being successful, but it certainly dramatically increases your odds. And it's little things like share structure. A lot of people don't really understand what that means, but everything that's determined or that has a pricing mechanism is determined by supply and demand. So if you're finding a company that's got a smaller amount of shares outstanding, if the demand increases, it's going to have a bigger impact on the share price. So that was one thing. You also want to see insiders with the right kind of vested interest. So, a company that has a higher insider ownership is likely, historically, to do better than something that has a very low insider ownership. So, those are just two of the things we look for. But after all the work we had done in the microcap space, you understand that to really find a extremely successful winner, you have to find companies that have growth, right? And not just small growth, but large growth, like 25, 50, 100% per year in top line growth on a per share basis. I can get into what the difference there, but really growth is a driver of real success in the microcap space. So that's the first thing we look for when we look for new microcaps. We're really looking for something that's growing very quickly. Now, one of the advantages you have in the microcap space when you're looking for growth is that a lot of other investors have a hard time pricing or valuing growth, right? Everybody thinks that a stock that's trading at 20 times earnings, it sounds expensive compared to one that's trading at 10 times earnings. But if that one at 20 times earnings is growing at 100% a year and the other one's growing at 10%, that 20 times earnings stock is significantly cheaper than the other one. But a lot of people don't really understand that dynamic. And once you do, it gives you a little bit more advantage when you're sort of competing with other investors.
In the market cap world, when we're looking at companies under, let's say, 300 million market cap, and I know it's debatable what that number would be. Is there a trade-off between profitability and growth / how much more they can scale? Is there a trade-off there? Do you find that companies that are profitable early on just don't have the same growth prospects? I'd love to hear what you think.
No, it's all over the place, right? So some of my biggest winners have been companies that have been able to compound for 10 plus years at an extremely high rate of growth, right? And yes, the law of small numbers will have an effect, but a company that was growing at 100% a year, even if it slows down to 50% a year, that is still tremendous growth. And it's always a function of what you're paying for that growth. So, there's a weird dynamic. The smaller the company, usually you get the smaller price earnings ratio, or call it valuation metric. And as it gets more exposed and more discovered, you find that the valuation metrics actually increase, right? So you're kind of paying higher prices for that growth as it gets better discovered. So in our view, you're actually taking on more risk the more it's discovered and the bigger it is than when you find it early.
And finding it early means getting in before the institutions, and they do have some handcuffs, right? Can you just explain that discovery process?
Yeah, so that's why we call ourselves small cap discoveries. Is we sort of look at that discovery process and try to understand where a stock is within that process. Most fund managers have a criteria that they have to abide by. And a lot of it is wrapped around the size of the company or the liquidity in that company. So that's actually something we do right now a lot. Is we sort of we've got a lot of institutional players that we're in contact with, and we're trying to get to understand where they are in the capital structure. Are they coming down market? Are they going up market? Are they looking for liquidity? Are they running away from illiquidity? These are all things that we look for to try to determine where to position. So it's that, I mentioned the advantage that we have as smaller investors. That's a big one. It was one of the first things I really noticed in terms of that common denominator amongst my winners was as soon as a company starts to hit like even a $50 million market cap, anything sort of sub 50 million, it's rare that institutional investors are there. But at 50 million in a bull market, they're standing there almost waiting at the door to try to pick off these stocks. So early on, I was noticing that certain companies, when they hit a 50 or $100 million market cap, their rate of increase in share price increased. Like it's almost like it was quietly climbing, and then as soon as it hit that market cap, you'd see almost exponential growth. So we did a lot of work around that to understand what that was, and it's exactly that. You've got institutions that either they're limited in terms of what they can do because of liquidity or market cap size. And once they sort of get access to a company because of market cap, you see a price inflection, and all of a sudden they're telling their friends, and maybe they're going on BNN or CNBC and mentioning the stock, and you see an even larger sort of increase in discovery. So we know that we take advantage of it as much as we can.
In 2021, 22, 23, those 3 years, it was very challenging for microcaps on the public markets, and recently the past year we've seen a lot of takeovers from private equity. Mm-hmm. Do you think that some of these institutions in these 3 years have gone up market? I have personally, and this is totally anecdotal, I've looked in some of the small cap funds that some of these banks and other institutions advertise, and they're not really small cap holdings. These are companies that are like mid cap and even above, between mid cap and large cap. So has the risk tolerance changed significantly?
So this is here's another weird dynamic. So when the markets get poor, or when liquidity dries up, and that's usually meaning a bear market of some kind, institutions actually have to go up market, right? They have to. So they're forced to sell these stocks that are less liquid, increasing sort of the pressure on these stocks and making them even more, even cheaper, right? And the reverse happens when we start getting a bull market, which I believe we're seeing right now as we speak. So it's like they're selling at the worst time and they're buying at the worst time, right? And again, if you understand that dynamic, you can take advantage of it. And that's what we've been doing over the last 2 years. So you mentioned, the sort of the dynamic of 21, 22. That's exactly what we witnessed. We saw it happening. And I'd say almost 2.5 years ago, we were pounding the table saying, folks, they're all out. All the institutional guys are way up market. This is your opportunity to take advantage of that. And we were fortunate. A lot of the opportunities we took advantage of are now being aggressively bought by those same institutions at 10 times what we were paying for them, 2 years ago. So we love watching that dynamic at play, and that's exactly what happens.
It's like being a kid in a candy shop,
It
right? These
is.
past
It
couple of
was.
years for you,
It
Paul.
was. But that being said, like you have to have the conviction that you're right because you feel like you're the only kid in the candy store, right? What's wrong? Why am I the only one in here?
That's really interesting. So you I think are still ranking as first place in the Microcap club, I believe, right? And you've been ranking first place for years now, probably since the dawn of time, maybe since it started, possibly. Um, what do you attribute that first place ranking to? Is that Expel? Was it, were you
Well,
one
the
of the
majority is
first?
Expel. The majority
The majority is
absolutely is
Expel.
Expel.
So
Yeah.
walk us through that discovery process. Like that was so early on that a lot of people listening to this won't even know what Expel is still to this day, I would say.
Yeah. So there's a process I do every year. As a matter of fact, I do it twice a year now, where I literally, in Canada, I go through every single financial filing on CDAR, which CDAR is a four-letter word to me lately. But so what I do is we pick over all the different companies that are listed to try to find the companies that are, meet the criteria that I sort of talked about, rapid growth and profitability and share structure and all those things. And through that process, I found this obscure little company called Expel. The stock was trading around 15, 17 cents at the time. It was profitable. It was growing. Nobody had ever heard of it. It met it sort of checked all the boxes we were looking for. And I think at the time it was trading around 8 times earnings. It had I think a $4 or $5 million market cap, like it was next to nothing.
Wow.
And it was growing its revenues at about 100% a year. And it had been doing that for like 8 quarters. So what was interesting is when I first found it, I told a few people in the industry, and they kind of looked at it and they came up with all sorts of excuses as to why they didn't like it. And I just kept looking at the numbers and okay, well, there's got to be something here. And it had an obscure product. I had never seen it before, but it was, for those that don't know it, they manufacture paint protection film for your car, right? So it prevents scratches and dings and things like that. So, I think we were just coming out of the recession. It was 2013, 2014, and people were saying, yeah, but that's a gimmick. Only expensive cars are going to use it, and they're not selling more cars and whatever. I was so many different excuses. But here I was, found the company, started buying as much as I could, and the stock started to perk up a little bit. And just around that time, I joined the Microcap Club, and that was my write-up. So what you have to do for Microcap Club is, to be accepted, you have to write a research report, and then that research report gets voted on by the existing members, and if they like the report, they let you in, right? So that was my report, and I remember putting it out there, and stock perked up a little bit, and I think it was around 40 cents when I wrote it up. And what I didn't realize was I was part of the discovery process, right? I had sort of brought it to a new audience. This audience had never seen the company before, had never heard about it. They started looking at it, doing a bit of due diligence, seeing the same things I did, and before you knew it, all of a sudden the stock's a little bit higher. I was just fortunate. I guess I was the first one to find it, but there's been many like that, thankfully. But yeah, I mean, it was a rocket ship when it actually really started to take off. For those that don't know, it went from about 17 cents where I first started buying it to over $100 US. And it's since still trading at about $45, $50. But along the way, I learned so much. It was one of the best performing stocks in Canada ever, and yet not a single analyst ever covered it in Canada, right? It had moved from, sub 20 cents to $8 Canadian. Well, it was always trading in US dollars, by the way. But went to $8, and then they moved to NASDAQ, and the first analyst coverage actually came out of NASDAQ or US when it was listed. So here's this company that did fantastically well, and yet almost nobody in Canada knew about it, right? And certainly the industry didn't care about it. And here's another thing I learned: if a microcap doesn't need capital, the the investment bankers and analysts have very little interest in these companies, right? So that was another dynamic that I understood there. But suffice to say, Expel did what it did. it gave me notoriety. I thankfully made a lot of money from it, but more importantly, I think it put me on the map as far as maybe this guy knows something or a few things. Yeah.
And you had some other bulls, I think, in Canada, some other microcap investors who joined you on the ride.
Yes.
Who are those?
Well, I mean, Jason Hirschman, a few people might know him. He's probably one of the funniest investors I know, but also extremely successful. He was, he did his due diligence on the company and took a very large position, did very, very well by it. And he's one of the smartest guys in the industry as well. There's another guy that I call the GOAT. I know he doesn't like publicity, so I won't mention his name, but he ended up buying close to 10% of Expel.
Wow.
So, did very well in his own right, but it wasn't the only one he's done well on. This guy is, he's just amazing. He's managed to hit some of the biggest winners we've seen in Canada over the last 4 or 5 years. And is just, one of the best at due diligence I've ever seen in the microcap space. But he also understands the dynamics that I explained earlier about the advantages we have here, and he exploits them to the extreme. Like, he's just very, very good at what he does.
So this elusive anonymous GOAT, he might have the biggest TFSA as well in Canada.
Well, that's a rumor. A lot larger than a lot of people, and I don't want to. He probably wants to avoid, Revenue Canada finding out about it. That's for sure. Yeah.
That's really interesting. What I love about your discovery process, Paul, is that you didn't mention once using a filter or a screen. A lot of investors, when they start out in large caps, that works using a screen.
Mm-hmm.
You put in a metric, gross margin, different metrics such as that, and you can screen. But you're missing so much. You're missing the majority of companies that go undiscovered because if you rely on a screen, you're missing out. You used to love the old CDAR because it was just so clunky. It was an Antica website coded who knows when, the 90s. And you loved it because you knew that people just didn't want to use it, and so there's an informational advantage for the people like you and others. I used to love it too. Who we're just turning over so many rocks, and it was like, hey, no one else wants to attempt it because it's so hard to do. CDAR recently upgraded the site, and I know you have a 4-letter word for the new upgrade. Tell me what you think about the new upgrade.
I listen. I mean, as much as I hate using it, I love the fact that it's actually. I think it's harder to use now than it was before, and I think that's deterring even more people from doing what I do. Right. So I used to complain about the old CDAR because of how clunky it was, but I question whether the word improvement can be used in this case.
So the upgrade has turned into an even bigger advantage for you because less people want to use it. Less people even know how to use it. I remember the first day I was tinkering around. I'm like, what's going on? So what do you prefer to use, Paul? Is it still a Stockwatch, I believe you're a subscriber to, and that's a little bit easier.
No, listen, I use all sorts of things.
Okay.
It's sort of, I have a bunch of tools in my tool belt, but you touch on something I think is important. So while early on in my career, I used software screening tools. But what I found was that every now and then, even some of the best screening software is going to miss the odd stock. And interesting enough, Expel was one of those companies. Expel was an oddball because it was a U.S. company listed up here in Canada, but it had it was trading in U.S. currency. So it had this weird .u suffix. And a lot of people thought it was some sort of either a unit or like those old
income trust, is that right?
Income trust,
the old
exactly.
One?
So it didn't show up in a lot of software screening tools. And I didn't realize this. I realized it by accident, actually, because after I'd found it, the way I, screening through CDAR manually, I tried to see it through some of the software tools that I had, and it wouldn't show up. So then I knew I had an advantage. So think about it. I mean, the one that slips through the cracks is the one you want more than anything else because it's even less discovered. So when I saw that, I said, okay, never am I using software tools again. I got to keep doing it manually, because that one or two that you get every year is more than worth the effort.
That's a beautiful thing. You recently posted on X.com about the importance of quality, and in italics, quality shareholders. Can you tell us more about that and why you wrote it?
Yeah, so that's another thing that I noticed in terms of common denominator for successful microcaps is, running a business is hard, right? And running a public company is extra hard, right? So there's a lot of things that a good operator has to learn as far as operating a public company, and you'd be surprised at how little of that expertise exists in the microcap space. Now, the larger companies, they can hire capital markets experts. They have, legal teams, and they've got all sorts of things to sort of cover what you need to know in the capital markets. But when you're a small company, you don't have those resources. So the value of the shareholder base can mitigate some of those issues. And I'll give you an example. Like, if a small microcap company that might have to go and raise money, if you don't have somebody in that company, and it's ideally on the board, that has capital markets experience and has a vested interest in making sure you're protected as a company, you're at the mercy of everybody that's out there, right? You're at the mercy of promoters, you're at the mercy of the investment bankers, you're at the mercy of everybody else that can take advantage of you. So that's something we look for. We want to see that the company has quality shareholders of some kind, somebody with a vested interest to make sure that, hey, Joe CEO, you're going down the wrong path here if you're going to go and try to do this kind of financing, or if you're issuing options this way, that's not a smart way of doing it. So those things that might not seem like a big thing when you're small, they tend to compound in sort of cost as the company gets bigger and bigger. So it's something we look for. Now, we use the example of somebody like a Warren Buffett being a shareholder of a company. If you can attract somebody like that, chances are you're either doing something right, or you can lean on them in terms of getting advice to make sure you're doing something right. So it's a big part of the due diligence we do to make sure we understand the sort of the makeup of the shareholder base. Now, sometimes the shareholder base is really bad, and knowing that, we can actually take advantage of it. We know that we can probably get the stock cheaper than we should, but there's a little bit more work to do to make sure that gets cleaned up. So, I really think people should understand how important that is. Another way of explaining it is, look, if you found out that Bill Gates was a shareholder of this tiny microcap software company, that should give you an indication, or at least a better indication, of the quality of the company, as opposed to nobody of substance, or the biggest shareholder is a butcher or a plumber. Not to say that they're bad, that's bad, but you get what I mean. Like, the quality of the shareholder and who has a vested interest in that company could tell you a lot.
Have you seen some horror stories out there of bad boards on microcap companies? Can you share some stories, maybe without naming the companies?
It's like probably more common than the other way around. Insiders that sell stock, days before a financial release, and then you think that's bad, but then you realize they didn't have a clue what they were doing, because the stock jumped 100% after financial results. Or options being set. Like, there's little things you can do just in the way you set options to better the optics. You don't set options because the stock dropped by 20% short term, and then try to take advantage of it. Sophisticated shareholders can see through that very quickly. Don't issue maximum set of options that are available. Have a board of directors that are willing to talk to investors because they understand the business. Be shocked how many times I talk to boards where they have no clue what's going on in the business. I mean, that tells me everything, right? So I've got a list an arm long in terms of things they've done wrong. Some of the biggest issues, though, really are around financing. It's the the disadvantage that small companies have when they go and they knock on the door of an investment bank and say, hey, we need to raise some money, and the investment banker says, okay, well, listen, I'll take care of you, don't worry about it, right? I mean, if you hear that, you should run. So you need to have somebody fighting for you on that board. So when we look at a board composition, for example, we want to identify that person, right? We want to identify that capital markets expert that can sit there and say, okay, CEO, this is what we have to do to really position ourselves properly. And if we don't see it, we get a little nervous.
For viewers of the show who don't know where to go to look up insider sells, they can go to SEDI, SEDI, to see any insider sells. Is it true, though, Paul, that there's multiple reasons why an insider, for example, someone on the board or the CEO, CFO, would sell a stock, but only one reason why they would buy? Would you agree?
100%. Yeah. I mean, sometimes you'll see some insiders buy purely for optics, right? They're buying small amounts, or you can, if you've been around the business enough, you can tell that it's likely just for optics. But the majority of the time, if you see an insider buying, they're buying it because they think the stock's going to go higher. Selling is a different story altogether, and this is something I think a lot of investors should really, really understand. Like, a lot of investors have a knee-jerk reaction to any kind of insider selling, and I think that's really, really misplaced. When I see insider selling, what that does is it makes me ask questions. I don't have a knee-jerk reaction. I've seen so many cases where insiders sell because they've got a tax issue. Their kids are going through school. There might be an illness in the family. And that's the reason. And a lot of times when I'm talking to CEOs, I'm adamant that, look, you have to take care of your personal finances first. Otherwise you can't operate a business. So it's things like that you got to look for. But no harm in asking the question. And you'd be surprised how often an insider will say, yes, this is why I've sold stock. But I've seen examples. I hate to beat this guy up, but I'll go back to XPEL. Early on, there was an insider that sold some shares of XPEL. He was XPEL sells into the auto industry, right? And he was a huge car buff. So the stock had, I think, gone up 5x in a relatively short period of time, and he sold some shares to buy himself a nice car. And this was sub $1. Right, so that stock, even after he sold, the stock went up by over 100x. And I kind of joke that was probably the most expensive car that's ever been purchased, if you factor in how much money left on the table. Yeah, exactly. So
yes, this is such a good point, and the reason why I asked that, Paul, is because it's not binary, right? Just because an insider sells doesn't mean it's bad. It doesn't mean that you should be frightened out of the company. I saw a case recently where someone was going through a divorce, a major shareholder, and they had to sell, I think, something like 1 million shares on the open market, part of those divorce proceedings. And so it was a forced sale. It wasn't because they thought the company was going under. So you also, it's not just about investing in straight line growth stories in the microcap space. There's also other opportunities. For example, turnarounds. So how do you look at turnarounds in the microcap space, and what things do you look for?
So, we actually don't do too many turnarounds. I've got a couple friends that, and even Warren Buffett says this a lot. There's a lot of turnarounds that never turn, right? I'd say the advantage in microcap spaces, or let's say the deals that work out the best are pure growth stories, right? So what you want to see is a turnaround that has that growth, right? And look, a lot of these microcaps have long runways. So I don't think you have to step in and say, okay, this looks like a turnaround story. I better get it in early, ahead of any validation that things are working. We don't mind turnarounds, but we want to see a couple quarters of significant improvement and turnaround that tells us, okay, we've got that maybe 5-year window of improvement coming. But yeah, we lean much more towards growth stories than we do sort of that deep value turnaround story. Now that being said, we've had some of our big wins over the last 2 years have been these sort of call them turnaround stories that we caught that have turned into really good growth stories.
Could you share one story about a turnaround that turned into growth?
Zedcor, perfect example. When we first found it, it was a sort of an oil service company that had, they rented out equipment. And then within that business, they had this little mobile security tower sort of service. And, the company itself was kind of floundering because the oil and gas service was in trouble. And they needed to completely restructure the business. So they vended off the traditional oil and gas service side of the business, and then they focused on the new product that was really growing. So that's a fantastic turnaround story. If they sort of kept the old business, I don't think it would have been anything close to what it is right now.
Is it true? I forgot where I heard it, but Zedcor security cameras can be found now in parking lots of Walmart, even in the U.S.
I think
they're
Costco,
just being sold
Walmart,
everywhere.
They recently built a school right down my street here, and sure enough, there's one of their towers. So
Interesting.
They're popping up everywhere.
Yeah. The business or the CEO? There's a debate amongst investors. What's more important, the business model or the CEO?
Yeah, that's a tough one. I think ultimately the business, right? I think there's a lot of examples of great CEOs that go into a business that is hard, right? Business as it stands is hard enough, but you can't duplicate everything. So the success that was in a different business or a different industry can't be readily duplicated somewhere else. And especially in the microcap space, thankfully I've worked, behind the scenes in sort of smaller companies, and I know the chaos that is there, right? And a lot of times these successful CEOs did it by pure perseverance and just a little bit of luck. And they can go on to something else and have the same sort of work ethic, but that luck didn't show up for some reason, right? So I love, I've got my sort of CEO Hall of Fame, where if they ever came to me and said, okay, Paul, I want you to write a check for this new venture, I would gladly write the check, no question. But it's usually the numbers that really determine success. So a great business, look, why have one or the other? I want both, right? I want to try to find that CEO that is doing all the right things with a business that is clearly evidently working. So yeah, I think we can have both.
Is talking with management before you take an investment in their company, when it comes to investing in microcaps, is it more important?
I almost never, I end up buying stock before I talk to management, right?
Interesting. Why?
Well, it's I don't want to be convinced by the manager, right? I want to be convinced by the numbers, and I find more times than not the numbers will convince me, and then when I talk to management, I may have a different view, right? I don't want to be poisoned by that view initially. There's been cases where the numbers look good, and then I talk to management. I go, this ain't. I can't line myself up with the CEO. It's not going to work. But there's been a lot of cases where I built a very large position because the numbers are screaming at me to do that. Now, I mentioned the GOAT, this investor that I've seen him pick up significant positions in a company well before he's spoken management. And so he's another example of management speak louder in their financials than I think they do when you're talking to them. That's the real litmus test for me is, a good management team will show up in the fundamentals, right? So yes, I want to talk to them for sure, but that is now to validate everything else that I've seen in the financials. If there's something that doesn't jive at that point, then I can start to scale out if necessary. But that's been my experience.
And then quality in the commentary itself in each of the quarterly releases differs. What are you looking for in the commentary section of these releases specifically?
sort of reality. I don't want too much fluff. I prefer managers that will tell me what could go wrong rather than talk about too much about what can go right. The CEOs that resonate with me are those that sort of under promise and over deliver, right? Somebody who is almost constantly telling you how bad things are, but then always making it better, right? And I can give you lots of examples of those. And again, Ryan Pape, Expel. I mean, there's so many check marks with Expel and a number of companies like that. They would always make sure that you understood the sort of the potential downside and not sugarcoat anything. That makes investing easier when you're already sort of predisposed to what could go wrong, and the surprise is the upside.
So you're obviously not a one-trick pony, Paul, because after Expel and that massive success, you went on to discover Hamilton Thorne. Tell us about that discovery process.
So so when we started Small Cap Discoveries, that was actually the first company that we highlighted and put in our newsletter. What I found was this was the perfect example of what is wrong and kind of what is right within the industry here in the microcap space. This was I'm going to say a sub $5 million market cap company. It was very nicely profitable and consistent, like not just a one quarter wonder. They were consistently making money. But they had a balance sheet that was offside. So they had this debt that had to be renewed every year. And because it was renewed every year, it showed up as a working capital issue, right? It looked like these guys were going to have to raise, I think it was $3 million. I can't remember the exact number. And it was a perfect example of how a smaller investor and a group like us could take advantage of that. So we recognized the income statement was stellar and the balance sheet. All it needed was a change in optics, because every year that debt was getting renewed and it was shrinking every year. So it was obvious what was going on here. The banks were happy to have that debt. It's just the optics didn't look good to investors and it kept people away. So we literally went in and said, hey, why don't we just raise you some money? We'll raise you some money down here. That debt's going to go away. Now the optics have completely changed. And lo and behold, I think we did the financing at 10 cents. We had warrants at 20 cents. And literally immediately after we fixed the balance sheet, the stock just started to run. And, that was a while ago, but it just recently got bought out. I think it got bought out for $250 million. It was a $250 million plus market cap acquisition. We were buying at sub $5 million. It started to get recognized by the institutions and the analysts significantly higher than what we paid for it. So that whole discovery process, that was it in a, I could almost write a book on that. It was just picture perfect. Retail investors, small retail investors find it early. Institutional investors find it later. Analysts, write it up significantly later, and then eventually acquired by a bigger company.
And then for me, outside looking in, what I find interesting, you look at Expel, you look at Hamilton Thorne, it was such a niche product, wasn't it? Mm-hmm. And like there's no other public company in Canada that you could invest in that was that exact product and business model. Can you tell me what Hamilton Thorne was in business doing?
Well, they did sort of niche IVF products. So products to help human fertilization and those that suffer sort of IVF issues. But it was not a common product. Like it was not. Yeah. And I'll tell you, like the majority of my successes in the microcap space have been in companies that dominate a niche, right? I don't want to hear that this company is going to go try to get 1% of this massively big market. They're going to compete against Google, for example, or they're going to compete against Apple. That's the last thing I want to hear. I want to hear that it is they got 50% of this niche, and this niche is growing at 10-20% a year. And it's because what that does is it prevents other major competitors from getting in there until it's significantly bigger, right? So almost every single company I've seen it turn into a 10, 20, 50 bagger has been this company that dominates a niche. That niche grows, and sometimes there's sub niches that they can attach to the business, and before you know it, you're significantly bigger.
Yep. When you're holding on to a microcap, you're seeing growth play out in the stock, but year 4 starts to flounder. When do you sell and why do you sell?
Okay, a great question. The biggest reason I typically sell something is I've either lost conviction or I find something that's better. Right now, if you think it through, I'm fortunate that I get to pick from 3,500 different companies in Canada. Right, so there's no shortage of ideas that are out there, and what we're constantly trying to do is trying to understand what the sort of the top 5 or 10 opportunities are that are available to us. And a lot of that top 5 or 10 have to do with this discovery process. The less discovered and less known a company is, the more attractive it is to us. So think of a company that may have 10x, 20x. By now, it's probably on institutional lists. It's probably already covered by analysts, and it's probably at maximum fair value to its rate of growth. Right, much more sophisticated people now understand it and may own it. If it starts to hiccup, there's a bigger chance for a drop than there would be in an undiscovered company. So one of the biggest criteria I use for selling is opportunity cost. I look at something that's done very well, that might be trading at 30, 40x earnings, much closer to its growth rate. I mean, one thing we use a lot is what we call PEG ratio, right? I know you're familiar with it. Mm-hmm. So something that's trading at 1 or higher is much more likely to be sold than something that's trading at 0.2 or 0.3, which I can find lots of those companies, right? So big sell criteria is really, can I find something better? Can I get that conviction I need in something smaller? And then of course, obviously, if the theory or the thesis as to why I bought the company is broken, if all of a sudden it goes from making money to losing money, or its rate of growth grows from 50% down to 5%, those are broken thesis, right? And that's when we move on as well.
Yeah, I remember reading One Up on Wall Street when I was a teenager, and that was Peter Lynch's favorite ratio, I think, right? The PEG, the
absolutely,
price earnings to growth ratio.
I love it. Yeah. We use it extensively, but we actually try to use an even more conservative model for it. So traditionally, it's you take the rate of earnings growth and you divide it by the price earnings ratio, right? We look at the revenue growth rate, which usually is less levered, and we try to use a PEG ratio of 0.5. And you'd be shocked in the microcap space how often we're finding these things, and it gives you a double whammy. You've got that high rate of growth, and you've got that sort of mispriced valuation to that rate of growth, and you rarely ever find those in sort of above $100 million market cap companies, right?
Absolutely, you definitely won't find it in the Mag 7 anytime soon.
Exactly, yeah, exactly.
So I don't hear this talked about much, Paul, but we basically have 3 exchanges in Canada. There might be more I'm just not aware of. You have the Canadian Stock Exchange out of Vancouver. Yeah. You have the Toronto Stock Exchange, including the Venture Exchange. And then you also have this new one called NEO, which it looks like it's picking up some steam. Tell me about your opinion on all 3. When it comes to picking stocks and selecting companies, do you avoid some exchanges? Are there differences? Tell us about that.
No, so we don't. They kind of have the pros and cons, right? But what I noticed very early is almost the harder it is to find a company, or the harder it is to trade that company, the more mispriced it is. So early on, we were early participants in the CSE, the Canadian Stock Exchange, because it was difficult for a lot of investors to be able to actually trade on the CSE. Now, it didn't matter to us the sort of where they traded. The quality of the company mattered more than anything else, right? So if we found a company that met our criteria that was trading in the CSE, quite likely it was even more discounted than something that was trading in the TSX or TSXV, right? So for us, it's irrelevant. Now, what happens is sophisticated investors will crawl through glass if they have to, if they find a good quality company. So it's almost irrelevant what exchange it trades on. Quality investors will find it. If they can take advantage of it, they will.
And that's another advantage
That's
that you
another
take in,
advantage.
right?
Yeah.
That's another advantage. What an example would be, I think, is the Happy Belly Group. They decided to list not on the TSX Venture, but on the Canadian Stock Exchange. Is that right?
Yeah, so it's actually a little bit easier to list on the CSE. Now, I took one of my companies, the company that I run, NameSaddle, is actually listed on the CSE. It was easier to list there than on the TSX Venture Exchange. We actually took it down from the Venture Exchange down to the CSE because it was a little bit easier. The challenge you have is because it's easier to list there, you get lesser quality companies that are listing there. So you sort of have to weed through more garbage to find the good stuff. But when you do, you got that advantage of mispricing. So Happy Belly Foods and a number of others, they're kind of they're in, you know, they're amongst a lot of weeds that you have to go through to get to that flower. But when you do, you know, you get that additional margin of safety and that potential for a higher rate of return.
Have you done any exploring on the new Neo Exchange? Are there any gems there that have piqued your interest?
There, like none that sort of pop in my head right now because, like, in a weird way, I a lot of the companies that we invest in, the exchange is almost an afterthought. Like, we've got a handful of CSE listed companies, and I'm sure we have a handful of Neo listed companies, but that's sort of, like I said, it's irrelevant. I have a hard time. I can tell you the symbol, but I don't know if there's a .V or .T or .C behind it. I just know the business more than I know where it's trading, and so almost the trading activity is secondary to everything we're doing.
And that's why I asked the question, because there's some investors that are so rule based, they'll say it has to be on the TSX, or the TSX Venture.
We see that, right? I would say, you know, the CSE for sure, you see some issues with people being able to participate in that exchange. I know a lot of international investors that we deal with have a challenge trading CSE listed companies. Significantly less so TSXV, and then even less so the TSX. But therein lies your opportunity. I go back to it. Like, the harder it is for some investors to be able to participate, the greater the chances that that's a mispriced asset. And remember, the larger it gets, the more options that company has to move to another exchange, and all of a sudden you get that valuation discount is gets sucked out of the stock.
So, Paul, when you found yourself as a lonely kid in the candy shop a couple of years back, valuations had come straight down for a lot of these microcap companies, quality microcap companies. What were you picking up? Which companies?
DRX sub $2. We were buying Zedcor. We bought Zedcor early, about 30 cents, and it sort of meandered around for a long time. The company that I joined right around then was Atlas. That stock was trading around 25 cents at the time. It's $1.25. Let me think back here. It's been a while. Zedcor, Enterprise. We were early in Enterprise, but even that I think was, after that time frame. Beware was an example of a company that we were starting to pick up a big position in. Vital Hub, I know you're a fan of Vital Hub. That was around that time. I wish I had the list in front of me. But
BioRem, I think, is another.
BioRem was about a year ago. We got very aggressive on BioRem. That's now 3x on us. Like I said, I'm losing my train of thought, but there were a number that worked out very well, all with the same sort of premise. It was we were buying double-digit growers. This was a little theme we had: double-digit growers at single-digit price earnings multiples. And to understand the way the industry works, especially in the microcap space, that was such a discount to the larger stocks, where you were seeing the opposite. Single-digit growers that were trading at 20, 30 times earnings. It just didn't make sense to us, and yet the capital flow was going in, and these things just got more expensive. That is not historically the way these things work. Small and profitable microcaps usually traded at a premium to these large companies. So we were seeing the exact opposite right now. And when I would talk to my institutional guys, the fund managers and whatnot, they said, no, we're not touching anything under 200 million market cap. So the combination of that kind of valuation and the fact that they were so up market, I knew it was a buyer's market.
Yeah, so these weren't just cheapies with a chance, as you call them in good bull markets. These are cheapies that were just way oversold.
and they have a very good chance of bouncing back.
Completely left for dead. Like just completely left alone. Yeah.
So, do you run a concentrated portfolio of microcaps, Paul, or is it more diversified? How do you describe the composition, and what does position mean to you?
So I probably at any one time I have about 20 stocks in my portfolio, but I would say the top 3 or 4, maybe as much as 80% of that portfolio. So I would say it's concentrated. It's almost like I run a hockey team, right? I've got my 4 or 5 all-stars that I try to keep on the ice as much as I can, and then all the others are trying to get in the lineup. So I've got these small starter positions in a lot of these stocks, and if they perform, they get elevated, right? I'll add to my position. But yeah, I mean, the advantage I have is, like I said, I go through 3,500 companies a year. I'm trying to pick the best of the best. I measure everything as an opportunity cost. So if I've got a large position somewhere, it better be one of the better ones I see out there. And that doesn't mean that I think it's going to give me the best return. It's giving me the best risk reward profile, right? As little downside as possible with as much almost guaranteed upside. So it's certainly not for everybody. But because I can sort of rate them against so many other positions, it gives me the comfort and the conviction to hold these things like I do.
So as Buffett talks about, right, error of omission, sometimes it keeps him up at night where he remembers that stock, he did all that research on, didn't pull the trigger, didn't buy it for the portfolio. What would be your most memorable omission?
It's the same thing. My biggest mistake is not a stock that I bought that went down. My biggest mistake is, and I actually own this stock. There's a company called Bowflex years and years ago, and everybody probably remembers.
I remember Bowflex, the commercials, yeah.
Exactly, right? So that used to be a TSX listed company, traded I think as low as 7 cents, but we were buying it at 80, 90 cents a share. And I'd say in about a year afterwards, the stock had 10x. We were selling it in the $9 to $10 range. And I sold my whole position, thinking I was a genius. That stock went up to $250. And when I look back, like it's one thing to say, listen, I didn't have a sell criteria. My sell criteria at the time was the fact that I was up and I thought I was a genius. I'm going to sell it and then try to go and find another one like that, right? These are pretty rare. When you get those kind of companies that are compounding, like this thing was growing to over 100% a year. And at a top line, I think it was growing about 150% a year in the bottom line. This was a machine, right? And I look back and the reason I sold it was because I was up. Probably the dumbest reason you should sell a stock. And I left a lot of money on the table. And I wish that was the only time that's ever happened, but it's happened more and more. What I've learned now is that these are rare entities, right? These 100 baggers are rare entities, and they have very similar characteristics. And you have to really look at different things, right? This thing was not something that had gone from 10 times earnings to 100 times earnings. It went from 10 times earnings to 20 times earnings, and it continued to grow. So it's helped me to look at new ideas differently. It's helped me gain conviction differently. I think conviction is really important if you're going to have a concentrated portfolio, and it's modified my sell criteria as well.
Speaking of conviction, what's the stock that you've held for the longest period of time?
Well, it's the one I run, right? So, and there's a lesson there too, right? I know this business better than anybody else. I know it better than any other of my investments. I have conviction in the management team, which happens to be me and several others. So it's I try to teach other investors to think as if they're buying a business outright, right? If you're going to go and buy that shoe manufacturing company as a private business, how much due diligence are you going to do? You're going to do a tremendous amount of due diligence, right? And you're doing that because you're going to be concentrated. That investment is going to be an extremely concentrated position. And you better have confidence in management and the employees and the product and all those things. So take that level of due diligence into even a small investment, and it's going to make your decision significantly different, right? I'm not just going to go and, flippantly buy a stock if I'm going to go through that process, right? I'm gonna treat it significantly different if I'm treating it as if it were my business.
Are there periods over your long career here investing in microcaps where you're just not finding any opportunities, Paul? Maybe for a 6-month, 8-month stretch. What do you do when you're not finding new opportunities?
So, well, first off, it's rare. There's always seems to be something out there if you dig deep enough. But they do come in bunches. Like it's odd how it seems like it's either dry period or it's raining cats and dogs, right? Usually, what I find is that that's an indicator to me that we're closer to the top of a market than the bottom of the market. And when I'm starting to run out of ideas, or all the ideas seem mediocre rather than spectacular, I start to get real nervous. And that's where my cash position might grow a little bit more. And that's where, I mean, we look at other things as well, but yeah, that makes me nervous when I run out of ideas. I know if you dig deep enough, you're always going to find okay ideas, but when the great ideas disappear, that's when you start to get nervous.
What's your take then on IPOs? And we know that IPOs have dried up basically.
Mm-hmm.
Maybe we'll see a ramp up in 2025, but tell us your opinion on IPOs.
So this is a great question. I think this is something we're talking a lot about right now. The market is a function of supply and demand, and I think part of the reason why you're seeing some of these great little microcaps, whether it's Zedcore or Enterprise or Cipher or these names, do so well is because that institutional capital, that big pool of capital, is coming down market, and they've only got a select amount of ideas that they can actually buy. And there's been zero, and I mean almost zero, new IPOs coming in to sort of replace some of these things that have either gotten too expensive or have been acquired, right? We've seen a lot of these great little companies get acquired. We've been fortunate. We've had 4 or 5 of our names get acquired here. But so that capital gets recycled, but it's getting recycled into fewer and fewer ideas. So at some point, the IPO market is going to come screaming back. I know of a few IPOs that are coming right now, and I'm kind of watching to see how successful they are. But there's a shrinking supply of opportunities right now, and at some point that IPO market's got to come back to satisfy that. So I think it's another indicator of where we are in the bull market, by the way. You've never really seen a bull market end without a complete oversupply of new IPOs, right? You're going to get a few IPOs that are going to come out, and 1 or 2 are going to be really good, right? Because the only ones that are going to make it across the goal line right now are likely going to be good IPOs because they have to be. And then what happens is those good IPOs are going to incentivize other companies to try to go public. And then what ends up happening is sooner or later, you start getting bad companies getting listed, and that's when you get oversaturated and then end of the bull market, right? So I think, if you want to call it a baseball sort of analogy, I think we're in sort of the second inning right now, this microcap bull market, because it's going to take 2 years to run that course of IPOs. I mean, if somebody wants to start an IPO right now, it's going to take 6 to 8 months before they can even come close to getting listed. And the pipeline of deals that I know they're coming out right now, they're still too small, and there's just not enough.
Yeah, there's not enough. Is there 1 or 2 that are piquing your interest here that you can talk about that are scheduled IPO?
I think almost the big test is the one that we're doing right now. We've got that it should come public in February. The demand has been spectacular. We're really, really happy to see the demand for it. But ultimately the test is going to be what the market does with it when it's public. So, come February, March, we'll have a better idea. There's a few others, unfortunately, that I've seen. They're trying to get across the goal line, but they're having a hard time getting institutional money to still come down deep enough to fund these things, right? These are $10, $15, $20 million market cap companies that are trying to list, and that's still a little too small for some of these institutional players. So they're having a challenge finding retail investors to participate.
Before we get into 2025 and your outlook and your best ideas, Paul, I observed something during our conversation here for just over an hour. You haven't made mention once about serial acquirers. There's a lot of investors who just concentrate on, especially the tech serial acquirer in Canada. Why was there no mention made?
Not by design. I mean, we love serial acquirers. two of our best performers in the last year or so have been serial acquirers. And then, one is Atlas. That's a company I'm a director of. They've made 8 acquisitions in the last 4 or 5 years. The other one is in one of the probably most despised spaces there is in the industry, and that's the cannabis space. We love them, but it takes a different sort of set of lens to make sure you're understanding what's going on. And we don't like serial acquirers that are doing it for the sake of acquiring. You want to see real strong synergies and a real fundamental reason to make these acquisitions. I was fortunate. I was early on in a company called Lowen Group years and years ago, and Lowen Group, serially acquired the funeral home industry. It was a magnificent run until they were acquiring businesses at outrageous prices because they had to keep acquiring. That was their whole reason to exist. So you have to kind of know why they're acquiring. You have to see the synergies. But I think there's spectacular opportunities when they're done right. I mean, obviously Constellation Software has been a huge hit. TerraVest is another example of a large acquirer that's done very well. And then when you go down market, it seems to get thinner and thinner, but there's other companies that are doing very, very well by doing it.
How are you feeling about 2025?
I think, we were really bullish in 2024, and it played out real well for us. I think it's hard to imagine it's going to be as good as 2024. But we see all the indicators that 2025 is going to be another good year for Canadian microcaps, right? Supply and demand, right? We continue to see private equity, of all things, coming and buying Canadian microcaps. Now, why is that a big deal? Private equity usually buys privately and they exit in the public markets, right? They're doing the reverse right now. Why are they doing it? Because the valuations are so low here. In some cases, you're able to buy publicly traded companies at discounts to their private comparables. Now, that rarely happens, right? So as long as that's happening, that's telling me the valuations are still, we're still in a buyer's market. But I come back to that supply and demand. I think we are woefully undersupplied good quality microcaps. You've got the institutional investor that is still significantly up market, although I see them coming down market, right? If you want to watch another indicator is how many bought deal financings these microcaps are seeing. That's traditionally mostly institutional investors that are participating. We continue to see the size of those bought deal financings, or rather the market caps that those bought deal financings are going into, is getting smaller and smaller. So that's an indication to us that these institutional investors are coming down market. Now, when you see, bought deal financing in a $10 million market cap company, run for the hills. By the time it's down there, that means these guys are really trying to just put money anywhere they can, and sort of criteria be damned at that point, right? We're nowhere close to that. So I figure 2025 will be a bit of a repeat to 2024, although the real easy ones are gone. You're going to have to go a little bit more down market with a little bit more risk. But that tailwind is not going anywhere. That capital is getting deployed. The momentum is there. And if anything, we've got a even smaller supply of opportunities for that capital to get pushed into.
How does the dynamic of lowering the overnight rate by the Bank of Canada play into risk tolerance when it comes to investing in microcaps? Is there a correlation, a lower interest rate and more excitement and more risk tolerance to invest? So,
historically, lowering of interest rates means there's a weakening of the economy, right? Which we're clearly seeing in Canada. So you have to factor that in for sure. But think of all the other dynamics that causes, right? So companies that have any kind of debt, their cost of capital actually goes down, right? Their interest expense goes down. So it somewhat lessens the risk from that standpoint. But also think from a buyer standpoint. I just mentioned private equity, right? Private equity, most of the times when they're making an acquisition, there's debt involved. So we were a little worried when interest rates went up. We were worried that this private equity buyer was going to disappear because their cost of capital went up significantly, right? So now they're not able to buy as much as they can. But look, now that their costs are coming down, they're more likely, even more aggressive to be buyers in this space. So we look at it a little bit differently. Yes, there's an economic risk that you have to factor in, but a lot of that gets priced in no matter what. So when you're looking at these opportunities, now you got to look at with, again, a different lens on, and look at them as potential private equity acquisitions. When we look at a lot of the companies that we get interested in, we say, would we buy the whole company out? And if we could, what would be the cost of doing that? So we think as private equity investors. So in my mind, the lowering of interest rates, while it's clearly an indication of a weakening economy, the buyer and that excess capital that's out there is going to get drawn into these even more because their cost of capital is lower and their opportunity set is shrinking.
Your opinion on the interest rate in Canada, you think it should go lower?
I do.
I've heard you say before. Yeah.
Yeah, I do. I think that there's a lot of structural issues in Canada that are not going to get fixed by just government, sort of initiatives, and a lot of it is the fact that we're not letting the economy kind of right-size itself on its own, right? We do a lot of work in the construction industry, and my background is the construction industry, and I understand that dynamic. One of the biggest levers we have in Canada right now to try to right-size the economy is this housing shortage that we have. And you're not going to get there if interest rates are elevated. If you properly want to deal with it, you have to deal with that cost of capital that not only the buyer has to deal with, but the builder has to deal with as well, right? So all those inputs are going to be driven by lower cost of capital that's really necessary here. Yeah.
Can you share your best 3 to 5 ideas, Paul, for us for 2025 as we enter the new year shortly?
Sure. Okay, so I'd love to. The thing I want people to understand, though, is that we look at everything on a risk-reward basis, right, and a discovery basis. So these are companies that I wouldn't say necessarily are the highest of quality, but they're going to give you sort of that Howard Marks approach. They give you the best risk-reward opportunity, and again, you want to sort of know these before the institutions and sort of they get properly discovered. So I'm going even further down market than we traditionally go. But there's a company called Z-Test Electronics, small company, CSE listed. So there's another example as a company that sort of gets mispriced because of where they're at. It's a small it's a printed circuit board manufacturer that goes into all sorts of electronics. Obviously electronics is not going to go away, but this thing is trading in single digit price earnings multiple, has lots of cash, too small for any institutional investor to participate. I think it's a $10 or $11 million market cap right now, but highly profitable, big cash balance that continues to grow, and like I said, very, very obscure to sort of the outside world. And certainly no investment banker is going to be touching this thing because they got all the cash they need, so you're not going to hear about it from too many sources. I got to go back to one of my favorite stocks right now is in the cannabis space. It's a company called Simply Solventless Concentrates. The reason why we like this is it's highly profitable, which is rare in that sector. But the reason we really love it is that they're out there acquiring assets for pennies on the dollar, and able to dramatically drive synergies because of all the different assets they're picking up very cheap. I think the last I checked, it's trading around a 7 times earnings basis on a pro forma basis, considering the recent acquisitions they've made, and plenty of opportunity in the pipeline to continue to grow in this fashion. So we like that one a lot. Another one that's obscure, that is just a pure profit business. It's a small company called Canaf Investments, symbol CAF, and they're based in South Africa. I mean, here's the reason not to invest in it. It's South Africa. They basically scrub coal, like they process coal and turn it into a product for the steel industry. And they also invest in South African real estate. I mean, things that you would think are probably scaring away a lot of investors, but you're able to buy it where the stock is trading, like half the value of the stock is pure cash, right? Just cash. And if you look at it from an enterprise value basis to earnings, it trades around 3.5 times earnings. So extremely cheap, tons of cash, but obscure and very, very misunderstood by the market. So there's 3 ideas. I can go on and on. I got so many ideas, but these are sort of $10 to $15 million market cap companies for the most part. Hash is a little bit higher. When I say hash is the symbol HASH on the Simply Solvent list. But they're all single-digit price earnings multiples with double-digit or higher rate of growth. Right? That's sort of the mantra we live by. And as long as we can find those opportunities, they just need to grow a little bit bigger until they get discovered, and all of a sudden their valuation changes dramatically.
Undervalued, profitable companies that are just underfollowed. I like your second pick. Like, who's looking at the cannabis sector anymore? Whereas 5 years ago, everyone was looking at the cannabis sector. It was a very contrarian of you.
Let me tell you, what we like to do is when we find something, we sort of push it out to some of our institutional investors to see what their thought process is. And I can tell you, when I started talking to some of these guys and mentioning a cannabis stock, they immediately shut the door on me. They would hang up the phone and just say, not a chance. We still have the scars from the last go around. We're not interested. So what's interesting here is the predominant investor that's buying this stock is a generalist. It's not somebody that understands the cannabis space. It's somebody who understands fundamentals. So it's a real interesting dynamic. The last time I really saw this play out was back in the sort of the dot-com boom and bust, when the last thing people wanted to invest in was anything internet related. And lo and behold,
it's like Amazon, no freaking way. I lost 95% in my and my mom's portfolio. The first pick, Z-Test, is an interesting one just because it's so cheap on a price to earnings multiple. What if, though, Paul, in the discovery process, and if you can give examples, there is no retail support. Retail doesn't give it liquidity. It never reaches that threshold where then an institution starts buying in. I'm sure you've seen examples, and they privatize. You never hear about them again. Mm-hmm. Are there examples of good businesses that just go away? They're just
Yeah. We see that all the time. That's actually a bit of a backstop here. So there's two things that we've seen happen with these. As long as a company is producing profit, especially free cash flow, where they don't have to reinvest in machinery and things like that, that's almost your insurance, right? They can start buying back stock. We've seen so many of these companies initiate share buybacks that sort of protect the share price to some degree. In some cases, what they do is they just put themselves up for sale, or they, management team takes them private at usually a nice premium to what we paid for it. So the fact that your profitable business has a lot of self sort of writing mechanisms within it that protects the investment. And sometimes we see both. A lot of the successful companies that we mentioned earlier, Enterprise, BioRem, even DRX. Some of these companies, they bought back a lot of their stock when the stock was cheap. So that also effectively, what it does, it gets rid of your worst shareholders, right? Mm-hmm. The quality of that shareholder base that I talked about earlier improves because, the person who's typically selling it as cheap as they are, that's usually your weakest shareholder. They're either misinformed as to the value of the company, or they need to sell that stock. So that's another reason why you want to predominantly hold companies that are profitable, because they can self-right themselves when the share price gets hit, or there's some weird sell-off, or they're undervalued for too long. They can put themselves up for sale, and boom, off you go.
As a bonus, Paul, for viewers, if you were to hypothetically short one stock starting Jan 2nd, 2025, what would it be? So
right now, anything that mentions the word quantum computing too much. No, I mean, there's been a couple stocks in the last week that have just gone absolutely crazy, right? And I have seen this before. I've been in this industry too long to know where the risks are. Not to say that these things can't go higher, because they obviously can. But more times than not, those kind of story stocks where there's no real fundamentals behind them, the story doesn't end well. So my bet would be on these hyper talked about companies that have no fundamentals behind them, that are going to have to finance, dilute to stay alive. Those are the ones that always get me nervous.
What's your opinion on Bitcoin? I think Bitcoin's the get-rich-quick scheme these days, isn't it? Have you ever invested in Bitcoin? Tell me what you think about it.
So I've never directly invested in Bitcoin, but Namesilo, the company that I run, Bitcoin is a payment method, right? So from any time we're actually taking in Bitcoin, and from time to time, the Bitcoin position will build up, and then we decide if we want to, convert it to cash. The nice thing about the system, though, is that when Bitcoin is low, we actually get more Bitcoin. When it's high, we get less. So it sort of self-rights itself. But I don't really have an opinion on Bitcoin. It's, for me, I get the theory as to why it should go higher. I get, this whole devaluation of currency and, printing of money and stuff like that. I get that, right? But I still have a hard time really understanding the sort of the value behind it. Why $100,000 and why not 150,000 or why not 10,000? I don't know.
Is this tulip mania, or is Bitcoin the next gold?
You know what? It's for me. It's on the too hard to know pile, right? So that's my excuse for not giving an answer. It could go either way. I think if it doesn't go to zero, I think it's going to go to $1 million, right? That's the kind of thinking I have here, and I have no idea which direction that's going to go.
Have you started tinkering around with Chat GPT or other Gen AI software to see how it could help you in the research process?
So, we've got some amazingly smart members in our network, and while I haven't done it directly, I've seen what it can do through some of our members, and I'm amazed at what the potential of this can do. So again, not directly, but I'm seeing some of the evidence of what it can do, and I'm excited about that possibility. I just hope it doesn't make CDAR easier. I want to make sure people avoid CDAR like the plague. Yeah.
So I'm going to make the argument that it's not possible to construct a Canadian-only stock portfolio. I think you would disagree.
Completely.
And why? Yeah.
Well, you can take... Look, I think there's fantastic investment opportunities around the world, right? Canada's not, doesn't have the exclusive rights to 100 baggers. But you have to decide you're either going to... sort of gain your expertise, call it vertically or horizontally, right? Horizontally meaning you're just going to go and try to find the best ideas anywhere, and then deal with it that way, or just to get extremely knowledgeable in a sort of a smaller vertical, which is what we've done. Like, I think I know the Canadian market better than I could possibly know any other market in the world. So why don't I use that expertise and that skill set and experience to dominate the Canadian market? Like, I know how to work through CDAR, right? To try to go and, do the same thing on EDGAR in the US or a filing system in Sweden or in Poland. I just don't think I'd be able to do it, right? So, listen, I'm an example, and I know other investors that are examples, that if you were to just focus on the Canadian market, even just the Canadian microcap market, you will find amazing opportunities that will change your financial life.
Favorite book of all time on investing, what would it be?
So the one that had the biggest impact on me, and there's been others since then, but the biggest impact on me was How to Make Money in Stocks by William O'Neill. And some of your listeners may have heard of the canceling process. That resonated with me early on, and the criteria I use is a sort of a Canadian version of the canceling. So that one by far had the biggest impact and changed the direction of my financial career by far. But there's been so many books, including this little one that I happen to have here.
Wonderful. Okay, Paul, thanks for the plug. I wasn't expecting that.
Yeah, it wasn't set up. Absolutely, that wasn't a setup. But I've taken like one or two key things away from so many different investors or so many different books. And like the reason I held up this book, and the same thing would happen with Market Wizards by Schweiger. There is no one way to make money in the market, right? Yeah. You have to get good at your way of doing it. And if you can, there's multiple opportunities to make lots of money here. So, certainly for my criteria, the can slim and how to make money in stocks was a big deal for me. But the other book I recommend for investors, especially those that are interested in the microcap space, is not what works on Wall Street, but oh gosh, now it escapes me. Jim O'Shaughnessy wrote it. Is it What Works on Wall Street?
I think it is What Works on Wall Street. It's a hulking book, like 700 pages, right? It's almost like the Bible. Yeah, it's huge.
I've got it
I remember reading that too.
But the reason that was sort of big for me was that I had kind of gotten to what the book describes. I got there by trial and error, right? To really understand where your opportunity is and where the real returns are, you have to go where the rest of the market isn't, right? And what that book did was it sort of encapsulated about 100 years worth of data and tried to find what segment of the market consistently outperformed every other segment. Do big caps do better than small caps? Do value stocks do better than growth stocks? All those things. And guess what it found? It found that small, profitable, and growing microcaps far outperform every other asset class, right? And I had to go through all sorts of mistakes and terrible investments before I finally realized that. Had I read that book, I would have saved myself a lot of time and a lot of money, unfortunately. Yeah.
And that's really interesting because a lot of people don't know about this. Maybe they've entered the investing world recently. Is that in the U.S., Microsoft was a small cap, Walmart was a small cap. All these mega big companies started out as small caps, but there's also the change today where will that ever happen again in the U.S., Paul? Do you think of a microcap or a small cap of that caliber becoming something big, a multi-$100 billion company?
I absolutely think so. I think in some ways it can happen a lot faster than it's happened in the past. The challenge, however, is, and this is one of the advantages of the Canadian market, by the way, the venture capital industry in the US is so strong that anything kind of looks good early gets picked up very quickly by venture capitalists and they go public at a much later date. In Canada, we don't have as mature a venture capital market, so you tend to see so many companies go public a lot earlier, and that's where the retail investor has an advantage, is if you can find the ones that have actually sort of got traction and validation, you can actually capture them similar to price points where US venture capitalists are able to do it. So that's actually why I'm a big proponent of the Canadian market, is because you still have that sort of public venture capital opportunity. You just have to know where to look.
That's such a crucial point. Last question, I promise.
Oh, no problem.
Pick an investor, alive or dead. You can have coffee with him or her. Who would it be? And it can't be Warren Buffett.
It can't be Warren Buffett, yeah. I mean, oh my gosh, there's so many. Listen, I've been fortunate that I've been able to have lunch and coffee with a lot of investors. Now, they're not necessarily well-known names, but I mean, Ian Castle's a really good friend of mine. I regularly get a chance to talk to him, and I wouldn't say it's because necessarily he's a good investor, which he is, but he's an ambassador for the microcap space, right? He gets it. He knows how to articulate the opportunities, and he's just a great speaker. So I love it when I get a chance to talk to him. But Howard Marks, I'm a huge fan of Howard Marks. Huge fan of Joel Greenblatt. These guys that they weren't necessarily given a whole bunch of money to manage. They had to earn it the hard way. They had to earn respect the hard way. They had to, in some ways, go into an unknown, unloved sector of the market and fight it out and make a name for themselves. So, I mean, there's lots. I mean, almost anybody in Market Wizards, I'd be happy to go and meet. Oh gosh, there's lots that I'd like a chance to sit on and talk to.
I appreciate your time, Paul. This might be the longest podcast that you've been on. It's just over an hour and a half. It was just such a fun conversation. Thank you again.
It went by so fast.
It really did. Thanks again, Paul.
Oh, I love it. Thanks, Robin. Take care. Happy holidays.